Hey, welcome to Mortgage Secrets. In the previous video, I've talked about how to calculate monthly income for the W-2 employees. If you haven't seen it, feel free to check out the link below in the description box. But today, we're going to talk about how to calculate monthly income for self-employed individuals. First, we have to break down to see what category and subcategory you belong to. If you have been in business for more than 5 years, that's category 1. But if it's less than 5 years, that's category 2. Now, in category 2, you have two subcategories: increased revenue in the last 2 years or decreased revenue in the last 2 years. Now, a little bit confusing, but let's go into each one of them for more details. So for the first category, if you have been in business for over 5 years, the mortgage advisor will take a look at the most recent tax returns. Now, they're going to ignore the revenue on the line 1, but focus on the net profit, the amount that you pay tax on. Now they're going to add some non-cash expense back to the net profit if you claim it, such as depreciation, depletions, car mileage, or any kind of other similar non-cash expenses. That will give you the new net profit. Then they average over the last 12 months. That's your monthly income for mortgage. So for example, you make $300,000 in 2020. That's you put on line 1 as gross revenue, but you deducted all the expenses. Let's say $250,000. Now your net profit is $50,000. And if you have depreciation of $2,000, now your new net profit will be 50 plus 2,000, that's $52,000. Then we take that $52,000, divide by 12 months, that will give you your monthly income. Now let's talk about the second category and which subcategory you belong to. Now the second category, just to remind you, is if your business is less than 5 years in operations. First subcategory, if you have an increase in the revenue between the last 2 years, then now we're going to calculate the new net profit for each year using the same method that we mentioned earlier in the more than 5 year category. So now after you have the new net profit of each year, you add them together and then divide by 24. That's the monthly income to qualify for mortgage. Second subcategory, if your revenue decreased in the last 2 years, then you go back to the same calculations at the first example to just average the new net profit over 12 months of the most recent years. And that's how you calculate the monthly income for mortgage. Just in case you forgot, here it is again. You make $300,000 in 2020. That's you put on line 1 as gross revenue, but you deducted all the expenses, let's say $250,000. Now your net profit is $50,000. And if you have depreciation of $2,000, now your new net profit will be 50 plus 2,000, that's $52,000. Then we take that $52,000, divide by 12 months, that will give you your monthly income. So that's how you calculate self-employed monthly income. There's many types of income out there, and we'll tackle each one of them along the way as we make more videos to explain to you. Now, if your scenario is a little bit more complicated or you're still confused about how to calculate, feel free to comment below or DM me, and I would love to help you calculate your qualified monthly income. If you like what you see or if you find any of this information is beneficial, feel free to subscribe to our channels, hit the like button, hit the bell notification so you don't miss out on the future value videos. Welcome to Mortgage Secret, and I'll see you in the next video.